another thing that has been around now for years and people are still messing it up every single day is picking up all of the information from the brokerage statement. So the brokerage statement that gets issued to you from Merrill Lynch and Edward Jones and all that stuff is reporting interest, dividends, and capital gains and capital losses. So the 1099, particularly the section of the brokerage statement that reports gains and losses, reports the proceeds. So it's a form that's called 1099B. The proceeds is what gets reported to IRS. Mm-hmm. The cost basis, not so much. So when you get your 1099 brokerage statement, you will see the proceeds and the cost basis. And to be honest with you, most of the brokerages now are pretty good at picking up cost basis. If they're super old stocks that you've transferred several times, they still may not have the cost basis, but for the most part, 99% of the time, I see brokerages reporting cost basis. The 1099B part is really just the proceeds. So here's what happens. You forget that you were supposed to get a brokerage statement. You know, Jo Ann, please remind me when I have a brokerage account that I forget about.
I can't wait. Goals are, I want to forget about businesses that I own, and I want to forget about brokerage accounts that I have.
And rental properties. So you let's say forget that you have a brokerage statement, or now they went paperless and you were waiting for this to come in the mail, it never did, and you get really busy and so you completely forget. That copy gets sent to IRS. Now, IRS sends you a notice, let's say a year from now or 6 months from now, to say, you have disposed of these 5 stocks and the proceeds from those 5 stocks were $1 million. So if I include $1 million in your tax return, you're going to owe now $200,000 in tax. Freak out, immediate. We get a copy of that notice. What's happening? I didn't get $1 million. Sure. IRS does not have the information on your cost basis. And people say, well, I disposed of $1 million, but actually the cost basis of those stocks were $1.5 million. So in fact, I have a loss. That's great. But we need to still tell the IRS that you have a loss. I see this, I don't know, at least once every 2 weeks, I get a client with, and they're going back years. I mean, you've got 3 years to look at these returns. I'm still dealing with notices from 17, 18, 19 for tax clients that have missed reporting brokerage statements and the proceeds from the stock sale, where we have to still match the cost basis. The common thing of what we do is we do an amended return to properly report the 1099 information from the brokerage with matching cost basis to show the IRS that in fact maybe you do have a gain and you owe some tax, but it's maybe not $200,000 figure that they've calculated, or maybe you now have a loss and in fact maybe they owe money to you. I just did an amended return 2 weeks ago where the guy just said, hey, it's a loss, I didn't include it. Sure, but actually now they owe you money because you could have used that loss. Mm-hmm. So that is going to get a notice right away. It's a guaranteed notice just because it's easy, it's a match. Here's where the kicker is for 2020. IRS is really slow to respond. So if they issue you a notice and you respond, or you get my help in responding, we do an amended return, we send it in. By the time they actually process that amended return to say that, yes, in fact, you don't have that capital gain to pay tax on, it's going to take several months. In the meantime, every 30-day, the notice showing that the change notice is still getting spit out. So now you're getting inundated with notices. The response has been sent and not processed. So it is going to be very frustrating. And I think we talked about IRS notices. It seems like every webinar. It is very frustrating, but keep in mind that's why it's even more important to really make sure that you have all the forms possible that you're aware of to give us for the tax return preparation so that we don't miss anything, so that we don't have to deal with this notice for 2020 and then have IRS hound you and then be slow to respond. So that is definitely one of my pet peeves. And people say, well, I didn't think about it. Well, it's a form. It's an IRS form. You got to give me all of the forms that you have so that I can at least properly, to the best of our knowledge, prepare the tax return. Jo Ann, don't threaten you with a good time. Any? Any thoughts there?
No, nothing you didn't already say that I wouldn't just say more rudely.
Then we're moving on.
I'm unsuitable. You cannot, yes, that's all. You've adequately covered that topic.
It's seriously one of my pet peeves. This particular, it's the matching of the information. The next one I want to.
Well,
yes.
let me. You're right. I'm not done. So the other thing is when you try to explain that we need basis, and it's something older, maybe it's a stock you've inherited from a family member, or something that's been around for a long time, or maybe something that you acquired before. You know, like a small business stock. So it's not on the exchange, or it's difficult to value. The fact that it's difficult information to obtain does not negate the necessity for it. So I feel like what would happen is people would be like, yeah, but I don't know. And they wouldn't help me until I gave them the tax return that said, well, you sold it for X and you had zero basis, and then you're mad. And then you go look, and then you have to find that. And if you don't have it, then we need to talk about what are alternate ways that we can back into the basis, maybe on some historical data that's posted with the transactions that we can maybe get to see, well, you bought these 50 shares in 2002, and here's what it was valued at then. It may take some legwork, some of which is done by you, or done by the broker, or done by us with the broker, or something like that. But when the list that we give you is not pleasant, it still needs to be done.
It's a lot better to give your best guesstimate on those bases than it is not to report the sale. In fact, we had a client who we're still preparing a prior year tax return for. It's an overflow now. It's really late, but he is having a hard time finding basis, and he said, you know what, I can't find my basis. Let's just file the tax return with what we have without including that brokerage statement. And I said, we absolutely cannot do that, because I'm not going to file a tax return guaranteeing you a change notice that then I will have to deal with and still continue to hound you, because then you have a deadline to respond, you've got interest and penalties. It's better to take your time and then ask for forgiveness on being late, but to really come up with your very best guesstimate on what the basis of those stock sales are. I mean, it's absolutely insane. The next item I wanted to bring up is, of course, sole proprietorship. So if you are self-employed and you are reporting your income on Schedule C, you have a higher chance of being audited. IRS knows that that Schedule C and that sole proprietorship is ripe for commingling business deductions with personal stuff. It's an opportunity for the small business owner to capture a lot of the personal expenses, whether they're done in a right or wrong manner. That is a very, very low-lying fruit for IRS to look at, to audit you. Jo Ann and I always say that when you ultimately are ready to convert to an S corporation or even a partnership, whatever the case may be for your business, same level of income and deductions looks a lot better and triggers a lot less audit when presented on an S corporation tax return. When it's presented on the individual return, it is immediately a trigger. Not to say that every single Schedule C is going to get audited. In fact, it's not. And they will look at a variety of high numbers on Schedule C and even low numbers on Schedule C, but definitely having a Schedule C. So the point here is that if you're a small business owner, you want to make sure that you have really, really strong system of whether it's bookkeeping, and I don't care if it's, you know, I'm not going to regurgitate what we had discussed about having the organizational system, but even if it's, you know, on a piece of paper and you write a list of your expenses and then you have little folders with the receipts in them, that's fine. That's a system. But you don't want to be like, well, I think it was $5,000, this deduction. You definitely want to make sure that your I's are dotted and your T's are crossed if you're a Schedule C self-employed individual.
The other thing about thinking about what your expenses are instead of documenting them is you have a tendency, because of lack of audit experience, to think in round numbers. Like, that was probably 50 bucks. When we see $50, I have a heart attack, because think about how frequently in your life do you go to Publix and the bill is $50 even. Never. I mean, second Tuesday of never.
Mm-hmm.
It's $50.85 or $47.65 or $118.59. It's not 50. So what we see particularly when people give us their thought about schedule of expenses is it's 50, 250, 5,000, 450, 850. False. If you hit that many 50s, there better be a W-2G for lottery winnings.
Yeah.
I need to see some like pay dirt from the casino, because you are lucky that you land on that many round numbers, and that also is a contributor to to the IRS computer system really looking at that for an audit.
Absolutely. You can have round numbers in some categories, like let's say your dues and professional fees. Our bill could be round, but definitely not supplies, not meals, not miles or auto expense. That is the chances of that being round are very, very, very small. Mm-hmm. And continuing on that train of thought, the next thing is a cash business. So it's one thing if you are a sole proprietorship. It's a whole new ball of wax if you are a restaurant, a bar, taxi cab company, if you are a hairdresser. Anytime there's cash in the business, the scrutiny from IRS is a lot higher. Again, all the more reason to definitely have good records. And here, they're not just looking at, are all those expenses business related. They're actually looking for underreporting of income. Mm-hmm. So they will ask for things like bank deposits if they're looking at it. That's the easiest first thing for them to ask, is to match the revenue that you're showing on that Schedule C to what has been deposited in the bank. Again, they will
That's
look
also how they find rental properties you forgot about. Like, what's this $2,000 a month deposited on the first of the month? Oh, that's rent. Oh, from what? I look at Schedule E and it's empty. I'm gonna need that. I'm gonna need that information. So really, one thing I will say to just pump in is when we talk about the low level of detection or high level of detection, you have to understand that the IRS is detecting better than 90% of returns at this point from a differential index function, which is essentially a computer algorithm that looks at you compared to the average taxpayer with your income. So let's say you make $100,000. You're being compared to the average person with $100,000 of income, and they go literally line by line to say, okay, well, the average person at $100,000 has $25,000 in mortgage interest and $4,000 in real estate taxes and $2,500 in charitable contributions. And of course, their averages are not exactly round numbers either, but they literally go line item by line item through the parts of the return. The more you are wildly different from the average line, the greater that increases your propensity for the return to be audited. And that calculator, that algorithm of the computer, is exactly what self-prepared computer-generated return programs are copying. So when TurboTax says, deduction finder, get to the end of the return and see what you missed, they're looking at the average person with your income to say, what line items did you screw up? Mm-hmm. So when people do, and they go, oh, charitable contribution should have been $2,200 and I have $150, what number do they change it to? Not $2,150 and not $2,325. They picked $2,200 and the IRS is like, that's my number. That's really familiar. I'm surprised you did exactly my number. And then boom, risk of audit goes up. So it's not a human being paging through your return looking at this stuff. It's all done by the computer. Like Marina was talking about earlier with the W-2s and the 1099s, that stuff is all matched by Social Security number, not by a human. So it's done immediately. It's all indexed, so they can see very quickly. They don't notify you quickly that you have missing income. That part's not fast. But for the computer to detect that you have missing income, it does so with ease because it's not a person performing those functions. Mm-hmm. So sorry for the hijack.
Oh no, this is perfect. In fact, one of my questions here was to ask you to talk about that algorithm and how things are being matched. So that is absolutely right. And especially, you know, when you're preparing that Schedule C where you report your business income, it's asking for the your business code, and that is also a big part of how the algorithm is detecting outliers compared to other businesses of this type, of this size, in this area, right, Jo Ann?
Absolutely. So, like, for example, we work with a lot of real estate agents. They expect mileage to be high for a realtor. They expect me as a lawyer to be sitting behind a computer. So if I turn up with, relative to my income, a bunch of mileage, it might be completely legitimate, but it might increase my chance of audit. So maybe I drive a lot to speak, which I do. But those things aren't normal for that business code. They also have a tendency to audit lawyers' returns more because apparently we're liars. So that doesn't help. Don't put lawyer on your code. It's not good. The other code that they don't love is consulting. So when you put generically for your profession consulting, that is like, also says liar to them. And again, not that there's a person thinking, these are just programmed into their algorithm software. I don't know what to even call it, but that thing that does all the detecting. So those are things you can't help. Your profession is your profession, but you want to make sure. That's why I'm militant about advertising. Advertising is one category inside any return that has always had a historical tendency to be fraught with personal expenses. So that gets too high relative to your income, then they want to look at it. I'm a big fan of the other line item on the tax return, whether it's Schedule C or in the S Corp return. If you're in real estate, you can put open house expense and you know, photography and all of these things, line item by line item. You can have as many other categories as you want. Other is really difficult for the IRS to compare to other people. If you dump all that stuff into advertising, now you get lumped in with everybody else. And so your number looks bigger. Again, even if your expenses are completely legitimate and completely documented, you can still avoid it. It's probably going to be a correspondence audit where you send the receipts in and they say, yep, no change. But you can avoid that. It's still stressful. People aren't accustomed to that. When they send it to me, I'm like, oh yeah, this is like a love note. But when you're not used to it, it is stressful and it does distract you from your regular workday. So if you can avoid it simply by different categorization of the same expenses, even better. Now, if we can document those same expenses, for example, mileage, and having a digital mileage tracker, even better, because now when they get into your return, it's kind of like having good handwriting in school. Like if I can read it, you're probably going to get a better grade. Like, oh, you have some records? They're probably going to give you the benefit of the doubt when you have things that maybe aren't perfectly documented. If everything's a disaster, I've seen them go to 0 on auto. You don't have your proof, 0. Yep. And they don't have to accept something that you go back and cobble together. So your obligation as the taxpayer is to keep your records contemporaneously. That means you write your mileage down as you go or track it as you go, not you get audited and then you pull out your Outlook calendar and try to back into where you went. I've had plenty of auditors accept that, and I've had tons that said, nope, don't sit down and write it now. I'm not going to take it. And mileage is easy now to track. It used to be really painful to get people, to comply, but now with everyone has their phone, everyone has an app. It's super easy. You can push the button and it'll send Marina the mileage, and then we decide what to do with it. And it avoids even the hassle and conversation where you're like, oh, let me find out when did I get my oil change and what was the mileage. And my favorite, I have a bunch of favorites. We'll get to some of them, but people would say, well, I drive, I'm always working. So 90% of my miles are work. Again, if you're thinking what your expenses are and not documenting them, that's unlikely to survive attack in an audit. You can just say,
well, and on that theme, Jo Ann, actually, auto expense was on my list, and particularly, And mileage, thank you for covering that, because that was one of the important things that I wanted to mention. And particularly, again, we are on that self-employed individual. So if you are preparing your business tax return, there's actually not a place where you have to enter mileage. You enter auto expense. So that is assuming that you went through the exercise and you have a work paper that says this was my business miles, and then, you know, times the rate, and this is auto expense. On the self-employed Schedule C, there's on page 2 is a separate section that says enter your total miles, enter the business miles, the non-business miles, and then also you have to enter, did you have another car available for use? You know, was this car used for business 100% of the time? So there's a lot more information that you're disclosing as a sole proprietor about your car and about the mileage. And that's the other part. And people say, well, it's 20,000 miles. Well, again, what are the chances of you driving and your miles at the end of the year being exactly 20,000? So if it's 20,000 somewhat, we want it at least to have a reasonable number on the miles. The other thing is, if you are taking a, not a mileage, but let's say you're taking actual deductions for the car. So there's a depreciation schedule that says, hey, this is the cost of my car. I'm taking depreciation, and then I'm taking gas, repairs, maintenance, and insurance, and whatever else for the car expense. On the depreciation schedule, it says, what was the business use percentage of this car? If you put 100%, you better have marked on that same schedule that you had another car available for use. Because if you say, I used my car 100% for business, and then you mark, no other car was available for use, that's an immediate audit trigger right there. So it is much better to, if you have one car, even if it's a higher percentage, let's say it's 75% business use, but it's not 100%, because that's what IRS agent, or even the first, it's going to go through the algorithm to say it's 100% and no other car was available. But then if it gets picked up by an agent, they're going to say, well, wait a minute. It's 100% business use. What are and you're a sole proprietor. What are the chances, and you're a lawyer. So what are the chances that you're not using your car to go grocery shopping and get a haircut and take your kids to school? So this is one of the very important things, is if you are trying to push the auto deduction, that's fine. We just need to be reasonable. You may have a car that's 100% dedicated for business. And a lot of realtors, for example, do, because they're just, car is their life, you know, they live in their car. And it is very common for a lot of my realtors have a car that is dedicated for business. We take 100% depreciation deduction, but they do have another car available for use, and we always mark, yes, the other car is available. So you may be a combination of one car is business, one car is mileage, one car your spouse drives, whatever the case may be. We definitely want to make sure whatever choice we pick on how we're going to deduct the car, that it makes sense and we feel really comfortable putting it on the return in that same manner.
Definitely. And that is, you can go back to the old adage of like, remember when you used to lie to your parents? Like, I did not eat the cookie, but there is like chocolate chips all over your face. Like having your own kids, now you see how dumb your lies were. Having done so many tax returns, I see when I see it coming, I'm like, nah, you can't tell me you work all the time and you didn't go to yoga or Publix or anything personal. The IRS doesn't believe it either. So that's not going to work.
Yeah, absolutely. The next expense that I wanted to mention is travel, meals, entertainment, things like that. Same thing. If the more you put in there, the higher the likelihood that it's going to get picked up to look at. Meals, I think this is definitely a worthy mention of the deduction, because in 21 and 22, we are allowed under this new law that passed to deduct 100% of meals expense. So this is sort of unprecedented. It's going to be brand new. A lot of people have had high meals deduction, and at least they were limited to the standard 50%. But now that you can get 100%, I think it's going to trigger a lot more attention from the IRS to say, okay, I get that it's 100% of meals now and not 50, but that number is still super, super high. Remember, you got to be reasonable about the meals. It's okay for you to have meals during business day, and you have clients, you have coworkers, you have potential clients, you've got employees, and you're providing a lot of meals all the time. But you also then have to go back and say, you know, what am I in the business of providing meals? You're not. You know, certain professions have a higher tendency to have higher meal expense. Back to the realtors, an example. You know, they're out all the time. Even if they're without anybody, they are on the road all the time. They stop by and eat sometimes 2-3 times a day if they're away. And then they have a prospective client. They may have, you know, a colleague, a realtor from the same brokerage that they're going to get lunch with. But typically the meal expense for the realtor is really high, but you still got to be reasonable. You cannot possibly have every single meal business related. And the other thing is, if you're in the business with your family, and okay, of course, every time you go out, you talk about business. You know, even if your spouse is not in the business with you, you talk about your business all the time. You cannot, it's unreasonable to say that every single meal that you have with your family is going to be business related. So again, you want to be reasonable. Travel is the same thing. Of course, there hasn't been that much travel in 2020, and that may also be what is going to trigger if you really had high travel for your business. A lot of times people combine personal and business travel to say, hey, I went on vacation, but I also stopped by and checked out some rental properties or whatever the case is. You want to make sure all of that stuff is documented. If you're traveling with your family, you're not going to deduct the travel expenses for all of the family. If you're the only one doing business, you can deduct your travel expense, but then you need to prorate and not deduct the cost of their tickets, but just yours. So these are the things where, again, it's ripe for misstatement. It's ripe for you to try and shove everything in there that, you know, really crosses boundaries between personal and business. And that's why the travel, meals, entertainment, that sort of thing becomes a super high risk of audit as an expense. Any thoughts there, Jo Ann, on the meals and travel and stuff like that?
Again, you know, we have to clean up the mess when I speak a lot, where people say, well, I heard if I go to Vegas and I just visit a brokerage, or I go to a business opportunity, the first day and the last day, the whole trip is deductible. Everything. I'm like, the IRS is onto that. Again, resort back to your lies I told mom and dad book. So no, if it sounds too good to be true, it is. If you did business 2 days out of 7, then 2/7 of your meals and entertainment, or well, not entertainment, but your meals and hotel are going to be deductible, flights, whatever. It doesn't make it, like putting the days on the front and back, like bookending it rather than doing it on Tuesday and Wednesday, doesn't change the amount or admissibility of the deduction of those returns, of those expenses.
Absolutely. The next item, continuing with the line of small business, is consistent business losses.
You're gonna make money eventually.
Yeah, you got to make money eventually. So what IRS is looking for here is a potential hobby. Sometimes our business feels like a hobby.
Because we love it so much.
Based on the number of hours we work, and it's like we really got to love it to be doing this. But you know, what they're looking for really is if you've got a loss, you know, 3 years in a row or so, and then if you don't generate profit after that, it may raise some attention. That's where algorithm can strike again, because they're going to look at a code. Certain businesses are expected to have losses for maybe more than 3 years in a row. But if your intent is to make profit, and you do get challenged that you've got constant losses for the last several years, then I think what would be smart to do is document what's happening. Or, you know, hey, we have a new business plan, or hey, we had this idea, it failed, and we took another loss. Or, you know, you want to make sure you have minutes, or you have a business plan, or you have some thoughts documented to say, you know, it's one day I will make profit eventually. I promise. especially in the first few years of the business. I think the startups are expected to lose for the first couple of years, but, or, you know, let's say right now in COVID, there's going to be a lot of businesses that will suffer. And I think that's also going to, you know, why this item becomes hot again in 2020 is because I think we're going to see a lot of those losses come through. And comes next year and the year after, IRS is going to expect that even if you had losses for a couple of years, that are you recovering and what kind of business is this and what is your intent? What is your intent on trying to make a profit and trying to reduce some of your costs? But so we want to make sure that we're looking at how many years the losses are and what type of loss it is.
And you're back to the reasonableness there. They're going to look too at a business, what kind of capital is required to start the business? Do you need it? Is it a restaurant? You need a bunch of equipment and furniture and things that are expensive, or is it consulting where you need a computer? So if you have giant loss in something like consulting, that's going to be more suspicious than giant loss in restaurant industry.
Absolutely. Getting away from the business, I wanted to bring up rental. Rental loss is also ripe for an IRS audit, and we have had instances where several of our clients were audited. What IRS is looking for here is it passive, is it active, or are you a real estate professional? Depending on where you fall into those categories, you may or may not be able to claim some of that rental loss against your other income. If the rental loss is passive, you're not allowed to take it. You basically get to carry it over until you generate passive rental income or until the property is sold. If you have some active participation, so you've got some involvement in managing this rental property, you're allowed to take up to $25,000 of rental loss. But again, you get phased out if your income is over $150,000 on your return. So once you're phased out, the rest of the loss that you're unable to take gets carried over again against future income or when the property is sold. And then you get to the real estate professional that everybody wants to be. With a real estate professional, you are in business of real estate. So you've got more than half of all your activities are real estate related, and you spend 750 hours in real estate related business. So it's the hours and it's all of your activity put together and what you do. And if you are a real estate professional, you are allowed to take 100% of the rental loss, which is fantastic because let's say your spouse has a high W-2 and you're able to reduce your overall total income from that high W-2 by the rental loss in your rental property. So it's absolutely fantastic, and everybody wants to be a real estate professional. In fact, you know, when our clients talk to us and say, I have all these investments, you know, what are the tax planning opportunities? And we always say, marry a realtor. That's been our common tax planning goal for them. But the idea here is that if you are claiming yourself as a real estate professional, you better have a good backup to that status. And it's not just the hours that you spend on particular property. It is going to be all of your approach on what you're doing with the real estate business. The IRS is generous in that ways that they're allowing you to combine real estate related activities together. So if you are a realtor, so you're in business of selling real estate to other people, and you yourself also have a rental property, even though you may not be managing it daily and stuff like that, but you are in the business of real estate. So you've got enough activities relating to real estate profession to be able to claim that rental loss. So the other important thing there is it only takes one spouse to qualify on a joint return. So you don't have to have both spouses be real estate professionals. One is enough for you to be able to get those rental losses counted against other income. But rental, anytime there's a rental loss that's passing through, again, a high likelihood of audit. Jo Ann, any experience there on your end that you've helped people get through?
Not anything different than what you've just said.
Okay. One item too, and we see these notices all the time, is premium tax credit. So that is also matching audit, in that it is not so much of an audit, it's a notice. So what that is if you have health insurance through Marketplace, Marketplace will issue you a form at the end of the year. It's 1095A. That form says, here was the amount of premiums that you paid, and here was the premium tax credit that we gave you. Because if you had an income level at a certain threshold, based on number of people in your household and etc., you are eligible to receive credit against those premiums. So it reduces the monthly premium that you have to pay. However, that credit is given to you as an advance. Okay, so when you're talking to a health insurance broker that deals with Marketplace, or you deal with Marketplace directly, they're going to say, hey, what's your income? Oh, my income is super low. Great. Based on you telling me that your income is low, we're going to give you X amount of credit against your health insurance premiums, thus reducing the monthly payments you have to make. And you're going with the assumption that everything is fantastic. But remember, the income that you gave them was your estimate, whether it was based on last year's income or your general estimate of what this year is going to be. Marketplace is using your tax return to reconcile whether what you've told them was correct and whether you were entitled to that premium tax credit. So the Form 1095A is supposed to go into your tax return and say, hey, again, these were my premiums. This was the credit that I received to help me with those premium payments based on this income. But hey, here's my actual income for that year. And when your income is reported in the tax return and flows through to that form, it's going to say, you know what? My actual income was actually higher than the income that I told you I was going to receive, and you gave me too much in those advance credits. And as a result, you have to pay some of those back. And that is going to be calculated on your tax return and added to the tax that you owe. And then IRS is going to be an agent and give that money to the agency that is helping you with the health insurance premiums. If you gave the income that was too high and your income was actually lower and you were entitled to more of that credit, you will actually get more of the credit on your tax return. And it's refundable. You will get a check from IRS to say, you know what, you should have gotten this much of the premium tax credit, you only got this much. What happens is, if you were issued Form 1095A from the Marketplace, again, back to the matching, that form is going to IRS. IRS is going to send you a notice to say, we got this form, you need to reconcile your income and the premium tax credit calculation to the tax return. We get those notices all the time. Yes, I had health insurance. Did you have health insurance? Yes, I did. Tick mark. Did you receive the forms? I don't know, maybe. I'm not sure. Here's some forms. I don't remember. Again, nobody's paying attention. If you have health insurance through Marketplace, you will receive Form 1095A, and we need to see it, because all we're going to do is have to address those notices later and have to reconcile your premium tax credit to the notice. So it is definitely not something that you want to forget about, and you need to be very diligent about getting those forms. You're back to the same thing. There's nothing bad that's happening, because we will prepare that reconciliation and we will send that as a response to the notice. But by the time IRS is going to get that notice and get that response and process it, it's going to take a long time. In the meantime, all of the reminders are just firing up. So that is definitely something extremely important. A few other items I wanted to mention: charitable donations. They always have been sort of an audit trigger, especially the non-cash donations. So if you are donating non-cash items, so if you're giving stuff to Goodwill and it's in excess of $500, it actually should go on a separate form on the tax return before it goes into your itemized deductions. And that's the form where you actually get to put a description of what you've donated, your estimate of the fair value, your estimate of the cost, that those items were purchased at back in the day, when that donation was done, to which charity you donated, etc. So my clients kind of fall into various categories. I have some clients that, again, it's, well, I don't know, there was a $3,000 worth of purses in that box. Okay, that's fantastic. And then I have other clients that give me detailed sheets where they go on goodwill.org and enter the item, and then, here were the socks, and now they're worth only $1. So, and then they give me a really good fair value estimate. And honestly, the truth lies somewhere in the middle. We don't want it to be, we don't want it to take months for you to be able to assemble that schedule, but just, again, be reasonable and really do document the things that you donate, particularly if they're not cash item. The year of the move, I always tell my clients, is a good year to capture those high non-cash donations, because especially if your address changed, especially if you move cross country, you would have cleaned out your house, you gave a lot of that stuff away, your old furniture, your decor pieces, your appliances, and then you bought all new stuff this year. That is a good year to really capture the donation. Again, document. If you're giving away some of the big items, you may want to get an appraisal. The Goodwill always says, yeah, I gave me the car, there's some appraisal. If you're giving stock away as donation, if you're giving artwork away, or maybe some collectible furniture pieces as donation, do get those appraised and have that, again, documented in that form. But that is definitely always ripe for audit. I also think that this year, I was reading, there's going to be, again, because of COVID and because a lot of charities were suffering, there was, of course, a big spike in sort of non-real charities that target people and, elicit the donations from them, even if it's cash donations. I think that a lot of the people with maybe higher cash donations will be audited as well. So please keep the documentation from the charitable organization to say, hey, you've given me $100 or you've given me $200. Some of those smaller ones you won't have a backup for. Let's say it's your local church and you give $10 every week, but if you're giving a couple of $100, you typically get a letter or some sort of piece of paper acknowledging it. Please do keep that for a potential audit. Charitable donations are definitely a thing. Anything there, Jo Ann, on charitable stuff?
My other favorite, Marina, how much was the bag worth that you donated?
Just give me the max.
The maximum. The maximum is not an answer. There is a value. Did you give me Versace or did you give me like Walmart? There's no maximum. Please don't ask me for the maximum.
Yeah,
that's all.
Absolutely. Yep. Some of the few other items that I wanted to mention, large withdrawals from IRA or 401k account. We will see a lot of those. Remember the COVID related distributions that people were taking last year. I'm not quite sure exactly how that's going to get audited and if this is going to be the year for the audit, because if you remember those coronavirus related distributions, you had 3 years. You could elect 3 years to either include that amount in your taxable income or to recontribute it back so it didn't get taxed. But I think that is going to be, if not this year, the next year is going to be on a really hot audit list. Generally speaking, that's always been a high audit item, just because they want to know, is it an early distribution? If it's an early distribution and you did not pay the 10% early withdrawal penalty, did you have a reason to take it out? There's always a list that's available if you do have to take early distributions that are exemptions from 10% early withdrawal penalty, and they will audit that. So, if you had medical expenses or, I think there's a list of 7 or 8 items that were exceptions. And again, it's not any documentation backup that you need to include with the tax return, but that's something that if they see that and they see that it was early, and you did not calculate the 10% early withdrawal penalty, it's very likely to get picked up and be audited by IRS. The last item on my list is international assets. So easily missed by a lot of individuals. Definitely been a high area of risk for reporting. So in I guess in the attempt to achieve transparency in the financial assets that people have in other countries, IRS has been working with other agencies, other revenue agencies in other countries. The reporting by banks has shifted tremendously over the years to generate all sorts of forms by individual and for businesses to say, these were the bank accounts that this individual had. Here were transactions back and forth between the different bank accounts. The idea is if you do have a bank account in a different country and there's an equivalent of $10,000 in total foreign assets that you have to report that. It's not taxable, but it's an informational reporting. And again, in their attempt to achieve that clarity and transparency of who owns what, if you do not report that asset, the penalties for not reporting are really high. Again, there's no tax. So typically, let's say if you underpay income tax, a lot of penalties are tied as a percentage of the underpaid tax. When it comes to this informational reporting, they just slap you with whatever penalty, different forms. So some forms are 25,000 penalties, some forms are 50, and sure, some of them get maxed out and others don't. So it is really, you really have to be careful. And even if you, let's say, move here from Canada and you may have a smaller retirement plan there, like a 401k equivalent, there's an RSP and you forgot about it and you never report it, it's always good to come clean and start reporting it. But it's definitely been a highly scrutinized area by IRS. Same thing is if you also have an interest in a company. So again, you are a business owner, you moved from England, you still have your business in UK, but you moved here, you're now a US tax resident, you're working, you're paying taxes, you've got maybe some dividends, some interest. You need to report the fact that you have business interest in the foreign country. And even if that bank account, as I mentioned before, is not in your name, but it's in your business's name and you as the owner have a signing authority, that also needs to be reported. That area is very complex and we're not going to get into those details, but just have an idea that any type of international financial assets are definitely an area that's scrutinized. I'm also going to throw in here cryptocurrency. Thankfully, we don't have clients really with cryptocurrency, but I believe they're adding to the 2020 tax forms. There's going to be a question to say, have you traded in cryptocurrency, or do you have an account? Where some of the cryptocurrency is in, and then if you mark yes, there's going to be some reporting forms. So that's also been coming out. There's some guidance from IRS about how to report it, how to treat it, what's taxable, what's not taxable. But that is definitely gonna, I think that's gonna be a much hotter item as we go further. So I'm sure we'll bring that on the next year's webinar, but just something for you to be aware of it. Those weird assets are definitely highly scrutinized. That was it on my list. Any specific questions, Jo Ann?
That's all I got.
Okay.
I think that's
excellent.
I will say I want to be respectful too of the time to give people a chance to jump off when needed. But as always, we record these webinars. They will be distributed to you for your viewing pleasure. In case you'd like to redo this or share this with someone, you can find them on our website at Koontzassociates.com or KoontZparkin.com. Also on our YouTube channel and on our Facebook pages. We will be back next Tuesday. We're going to be talking about homestead. It's a good time of year to talk about that and get people up to speed. Your deadline is coming to get filed. So we'll talk about what it does for you, how to get it, transferring it. We'll talk about myths and kind of get that cleaned up for everybody. So if you have questions, as always, or topics you'd like to hear about, you're welcome to email us, and we'll be happy to make sure that we're presenting topics that you guys want to hear about. So thank you so much. Have a great weekend. We'll talk to you next Tuesday.
Thank you.
Bye.